Eric Muather, themuather.com, with U.S. market analysis for the weekend of January 14th and January 15th, 2017. Let's take a look at markets here at the close of Friday's session. Pretty much, let's call it a slightly up day. Nasdaq was up the most, Dow was unchanged, S&P 500 up about 0.18. We see that crude oil was down about a percentage point and gold was pretty much unchanged. Let's take a look at those charts. What we see is that net for the week, S&P 500 was pretty much unchanged, down about 0.1%. For the week, the Dow was down 0.39%, so not much change there. And as far as the Nasdaq was concerned, it was up about a percentage point. So that was what the return for the week was. Let's take a look here at the Nasdaq weekly chart. And even though the Nasdaq was up about a percentage point for the week, in terms of the technical picture, not much has changed since last week. We can see that we are still contending with topside resistance. If you take the highs on the weekly RSI, you can see that we are still struggling to move above the topside RSI resistance line. And until we can clear this resistance, this market ultimately is going to struggle to move higher. And for the Nasdaq, as it closed at all-time daily closing highs, we still see that it is struggling to move above the recent RSI topside resistance line. And for the Nasdaq also, there's another layer of resistance on the daily RSI. This red line has been resistance for the Nasdaq, and we still not being able to move above those two lines. Suggests that even day to day, the Nasdaq is not showing all that much strength on the technicals. It would need to trade above those two lines if the market was to trade even substantially higher. So right now, as far as the daily chart is concerned, we still continue seeing topside resistance and the uniformity line resistance, which right now suggests that until we can move above these two lines, chances are for the Nasdaq also, the next potential swing trade might be to the downside. But don't expect the market just to drop off without some fight, because right now we are still showing the Dow holding above 69.1 on its weekly RSI. And as long as the Dow is holding above 69.1 on the weekly, the market should be stable to bullish. Additionally, on the Dow monthly chart, we continue seeing the Dow holding very well and stubbornly above 69.1. We've been saying that as long as the Dow is holding above 69.1, expect this market to continue being strong. If we take a look at the Dow from a weekly standpoint, we can see that the Dow did make some technical error, if I can call it that way. We made an improvement hour to hour. Take a look at what the RSI did on the hourly chart. It made a high but did not move above 61.8. That tends to be the worst negative divergence and might set the stage eventually for a pullback as far as the Dow is concerned. Keep in mind, we also saw the S&P 500 this past week make improvement in hour-to-hour closing highs, but the RSI made another lower high, and it also was showing resistance at about 61.8. Again, this is the worst type of negative divergence, which ultimately might set the stage for markets dropping even further than the current price range. If we take a look at the S&P 500 daily, we can also see that over the last couple of days, it did make an improvement to all-time daily closing highs, but the RSI made a lower high. Again, we see emergence of negative divergence even on the daily, suggesting that ultimately it might suggest that we might see lower prices based on this negative divergence. And additionally, on the weekly for the SPX, just like we've been discussing, it continues to show a resistance line connecting RSI highs, just like the Nasdaq. In fact, here for the S&P 500, we see that it seems to be forming what looks like a double top over the last couple of weeks. So until it can clear that line of resistance, so until we clear this line of resistance on the weekly chart, chances are that this is suggesting that with the confirmed resistance, we might be looking for a pullback. So it's really the best way of looking at this is if the bulls want to take the market substantially higher, they need to clear this well-defined line of resistance. Otherwise, the more it continues being confirmed as resistance here, the more we are looking at a market that for the most part seems to be suggesting that the next meaningful direction is lower. If we take a look at the S&P 500, let's watch this monthly chart, because if the S&P 500 can move itself back and trade above 69.1, that might be very bullish. So watch this level here, S&P 500 moving above 69.1 might be very bullish, because as you can see on this 8-year weekly chart, that once the S&P 500 moved itself above 69.1 in early 2013, so we're talking about this period here, during this breakout right there, the market stayed for the most part above 69.1 until sometime, let's call it here in early 2015, during these highs here. So the market went on a major run during this phase when the S&P 500 was above 69.1. That's why I say it's a big deal. Now I'm going to change here and also explain that if the market stalls around current levels, so in other words, if the S&P 500 stalls and confirms resistance here, this might be a problem for the market. So this turning down, being red for the month and confirming resistance on this red line is also a sign of a market that could go into a major bear market. And the reason is, if you take a look at the S&P 500, so assuming that this RSI break, this long-term trend line break in 2015, which brought the market lower, so we had a relative drop there. So what the market would do if it turns down is show resistance on this line. So we are assuming that this is confirmed as resistance in the coming weeks. That might be a bad sign ultimately, because if you take a look at that same level, the two major bear markets have begun on this same red line. You can see that the break of this trend line and also moving below that previous red line there, that break of those two lines brought the market off the highs of late 2007 before we went on a major bear market drop. We also break another trend line right there in early 2000, and of course we went on another major bear market drop. So resistance month to month on this level might be the sign bears are looking for an impending major bear market. So that's why I keep saying we need to watch that RSI level, because that's going to determine what the markets are going to do short term. If you are bullish, you want the monthly chart for the S&P 500 to move above 69.1. Those who are bearish would like the market to stall around here, and ultimately for the S&P 500 to be rejected around current level. Otherwise, that's it for the free part. Subscribers, be on the lookout for part 2 of this weekend's market analysis video, where we're going to look at commodities and take a look at some stock picks. I might have it most likely on Sunday at some point, or maybe even on Monday, since it's a public holiday. Otherwise, enjoy the rest of your weekend. Peace and blessings. E-A-C-S. Mwah. Woo!